What's good, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So let's get it started. So lately I've been getting some emails about how to pay off your credit card quickly. I mean, I don't know what it is. I guess it's vacation time, women taking their hot girl summer trips. Either way, we're gonna talk about how to pay your credit card off quickly using a line of credit. But before we get into it, you already know your boy has to do the YouTube thing. So your boy's on the verge of getting monetized. So I'm gonna ask you guys, help a brother out. If you haven't done so yet, go ahead, smash that like button. Make that thing turn blue for me. And if you're new to the channel or haven't done so yet, take a little bit of time, hit that subscribe button for me down below. I really do appreciate anybody that takes the little time to do so because it helps me reach a higher audience base. Also, I encourage you guys to leave some comments, feedbacks about my video, and share my videos with others that you believe that will benefit them. All right, so if you watch my older videos, you already know that when we talk about velocity banking, it is income pays credit, credit pays expenses. So since we borrow money from the bank, our line of credit, to pay off our credit cards, we're going to be freeing up cash flow. We will then use our income to pay the line of credit and then use the line of credit to pay our expenses. So the leftover money, our cash flow, is going to stay into our line of credit until the line of credit is fully paid off. Now, this may sound complicated, but you already know I got the whiteboard in the back, so we're going to break it down. Let's go. All right, so we're on the whiteboard. I haven't been on the whiteboard in a minute, but you already know we get down to business here. So we're going to have Mr. and Mrs. bounce back. They're going to bounce back from having a lot of debt on their credit cards here. So let's get it broken down. The income they have together for the month is $6,000. Their expenses is $5,700, which means that they're going to have a cash flow of $300 per month. Now, they're going to have to be paying off 4 credit cards that combine with a total of $5,000 of debt. So, credit card number 1 is going to be $1,000. The minimum payment they have to pay every month is going to be $100. Credit card number 2 is going to be the same, of $1,000 of debt, minimum payment $100. Credit card number 3 is going to be $1,000 of debt, but the minimum payment is only going to be $50. And credit card number 4 is going to be $2,000 of debt, and the minimum payment is going to be $50. Now, Mr. and Mrs. Bounce Back, they went to the bank, they applied, they have a line of credit for $3,000. So we need to remember, income pays credit, credit pays expenses when we break this down. All right, so we're on the other side of the board. Let's get this broken down here. So the month of January, how this is going to read, this is going to be the amount of the line of credit at the end of that month. So we're going to straight go down to the equation of how we do things here. So day 1, let's say it's January 1st, and they have that $3,000 line of credit. What they're particularly going to do with the line of credit, they're going to use the line of credit to pay off both credit cards, credit card 1 and 2 of $1,000. So we have a line of credit going onto this credit card and that credit card, and that is paying it off in full. What this does, it frees up cash flow, because part of our expenses, the $5,700, was the minimum payment for those cards. So credit card number 1, the minimum payment per month is $100. Credit card number 2, the minimum payment was $100. So we freed up $200 of cash flow, and we lowered $200 of expenses. Now our expenses are going to be $5,500, and our cash flow is going to be $500. So that's the first step. The next step, we're going to use $2,000 of our income. So within the month, however they get their income, weekly, bi-weekly, monthly, whatever it is, they're going to use $2,000 of the $6,000 of income that they have, they're going to put that onto the line of credit. That means that the line of credit is paid off in full because we use $2,000 of the $3,000 of the line of credit. And one thing to note, why we only used $2,000 of the $3,000 of the line of credit is because we always want to have some money for an emergency. So we only use 2/3 of the line of credit. Just in case something happened, there's $1,000 on the line of credit where we're able to use that money for an emergency. So we just need to make that clear. So since we paid the line of credit off in full, we're on to step number 3. We're going to use the $4,000. That's the rest of the bounce back income of $6,000. So we're going to use $4,000. We're going to pay for the expenses. Remember, the expenses went down to $5,500. So if we do the math here, we would still owe $1,500 in expenses. Now, how are we going to pay the expenses off? Easy. We're going to use our line of credit, which we paid that in full, is back up to $3,000, and we're going to use that to pay the expenses. So if we do the math, 3,000 minus 1,500, we have 1,500 on our line of credit. So at the end of January, our line of credit is $1,500. All right, so on the month of February, let's take some notes here. I do have a couple magnets on here in regards to the changes that have occurred. So we know from step 1 that our cash flow and our expenses went up by $200. So we see the expenses are $5,500. Our cash flow is up to $500. Step 1 is actually eliminated for the month of February because we're not going to be paying off any credit cards. So we're going to go straight to step 2. So the end of January, beginning of February, our line of credit has $1,500 on there. We want to pay that off in full. So $1,500 of our income, of our $6,000 that we get for the month of February, whenever you get it, weekly, bi-weekly, whenever you get it, you're going to put $1,500 back on to the line of credit. That's going to pay it back to full, back to the $3,000. Now, we're going to use the remainder of our income, $4,500, to pay most of our expenses. Our expenses are $5,500, and it's going to leave us with $1,000 left for expenses. Now, how are we going to pay off the rest of the expenses? We already know. We're going to use the bank's money, the line of credit. So the line of credit we're going to use to pay off $1,000 of the expenses, which is going to leave us with $2,000 at the end of the month on the line of credit. So for February, our line of credit is up to $2,000. We see that our debt is still $3,000 because we still have to pay off card 3 and 4. All right, so we're at the month of March. Now, since our line of credit is at $2,000 and $3,000 is our line of credit limit, we're back up to that 2/3 ratio. So what we're going to do, we're actually going to go back to step number 1, and we're going to pay off another credit card. So credit card number 3, we see that it's $1,000 and the minimum payment is $50. So what we're going to do, since the end of February, our line of credit was at $2,000, we're going to take $1,000 of that $2,000. We're going to apply it to that third credit card. Now, when we do that, that pays off that third credit card, and we don't have to worry about that minimum $50 payment per that month. So what that does, it increases our cash flow by $250 instead of the $200. So it's also going to eliminate $250 for our expenses. So if we take a look, our expenses are at $5,450 and our cash flow is going to be at $550. It's not on there, but it's supposed to be $550. So that is going to be step number one. Step number two, we're going to use our income. So together, the bounce back couple, they have $6,000 coming in every month. So in the month of March, however they get it, they're going to use $2,000 of that $6,000 to pay off their line of credit. So it's going to bump that up to the $3,000, pay it back in full. Now, the income, the rest of their income, $4,000, they're going to use on the expenses. Their expenses, remember, went down. So it's $5,450, which will leave the expenses at $1,450. Now, how are we going to pay off the expenses? We already know. We're going to be using our line of credit. So remember, it's back up to full, back up to that $3,000. We're going to use that to pay off the remainder of the expenses. And what we're going to have left is $1,550 on our line of credit at the end of March. All right, so we're at the month of April. I finally got the cash flow corrected, so it's $550. Now, since we paid off credit card number 3, we're looking at the end of March, we have $1,550 on our line of credit. We aren't able to pay off the last credit card yet, so we're going to avoid step 1 for now, and we're going to go to step 2. So since the line of credit is $1,550, we want to pay that back up to full, back up to the $3,000. So the bounce back couple that have $6,000 coming in for the month, they're going to use $1,450 of that $6,000 to pay off the line of credit back to full. Once they do that, they're going to use the remainder of their income, $4,550, to pay most of their expenses. Their expenses $5,450, which will equal $900 left that they have to pay for expenses. Now we know how we're going to pay this off. We're going to use our line of credit. So our line of credit is back up to full. Our expenses are only $900. We're looking at the line of credit goes up to $2,100. So we're slowly paying that off. Remember, our cash flow now is $550, and we started with $300. Now, you got to remember, income pays credit, credit pays expenses. That's pretty much what we're doing when we're doing these equations. All right, so we're on the month of May. So we're quite not ready to pay off credit card number 4. Because if we look at our line of credit, it's $2,650. If we use $2,000, we'll only have $650 left. So that's cutting it pretty close, because remember, we want to have additional money on our line of credit just for emergencies. So we're going to go to step 2 again to pay a little bit more of our line of credit off. So step 2, we're going to use some of our income, $900, because remember, in April, the beginning of May, our line of credit is $2,100, and we want to pay that in full. So out of the $6,000 of income for Mr. and Mrs. Bounce Back, they're going to use $900, get that line of credit paid off in full. They're going to go to step 3. They're going to use the remainder of their income for the month of $5,100 to pay majority of their expenses. Expenses $5,450, leaves them with $350 that they owe in expenses. Now they're going to use their line of credit like we know they're going to, and they're going to pay the remainder of their expenses. It leaves the line of credit at $2,650 for the end of that month. All right, so we're in the month of June. So we're getting really close on our line of credit to paying it off in full. So the line of credit is at $2,650. We could pay off the credit card because it's only $2,000. What I would prefer to do, since our cash flow is at $550, I'm going to choose to do another month of paying off the line of credit. So what we're going to do here is go to step number 2. Our line of credit is at $2,650. To pay that off in full, we just need $350 out of the $6,000 of our income. That's going to pay the line of credit to full. We're going to go to the next step. We're going to use the remainder of our income, $5,650, and we're going to pay all of our expenses. What this is going to do is going to leave us an extra $200 that we can't put in the line of credit because our limit, remember, is $3,000. So the final step, we're not even using our line of credit because the expenses are zero. So how this reads for the end of the month, so we don't get confused here. So the end of June, our line of credit is actually $3,000, but to get the visual, I put $3,200. The $200 is spare money, so we would have to keep that into like a checking or a savings account. So just note that this is actually $3,000, and we have $200 of spare money in our checking or in our savings account. All right, so we're on the month of July, and things get a little tricky because we are going to be paying off the final credit card of that $2,000. So what we have to look at is we're looking at June. Remember, our line of credit is $3,000. We just have a spare $200 in our checking or savings account. So what we're going to do here is we're going to use the line of credit. We're going to pretend that it's $3,200. But what you would do is $200 of your cash you will put onto that credit card of the $2,000, and then the remainder, the $1,800, you would put onto from the line of credit to the credit card. But to make it simple, pretend we have $3,200 in our line of credit. We're going to use $2,000 of that to put onto the credit card to pay it completely off. What this does is it increases, because the minimum payment for that $2,000 credit card was $50. It increases our cash flow. So now our cash flow has increased $300, because remember, we started at a $300 cash flow. The cash flow is at $600 now. Now the expenses in return, they would decrease by $300. So our expenses now are $5,400. So what we're going to do, since we got that paid off, we're going to go to step 2. We're going to have to use our own income of the $6,000 to pay the line of credit back to full. So we're going to use $2,000 of that income onto the line of credit, and then that will pay that up to the $3,000. We're going to go to the next step and use the remainder of our income to pay majority of our expenses. So our income is $4,000, expenses $5,400. That leaves the expenses left is $1,400. So we already know what we're going to do. We're going to use our line of credit since we paid it off in full, and we're going to use that on the remainder of the expenses. Now, our line of credit will be $1,600, but again, the $200 that we actually use towards the credit card, because we never used the $2,000 on the line of credit, only used $1,800, we would have $1,800 on the line of credit. So we're just adding $200 from this equation, because that was our spare money. We're putting it right there. So the line of credit truly would be $1,800. All right, so we're close to getting done here. We're at the month of August. So what we're going to do, we can avoid step 1 because we have all our credit cards paid off and we have maximized our cash flow. We're going straight to step 2. So we got to look at our line of credit ending in July was $1,800. So we want to pay that back to full. So we're going to use $1,200 of our income, the $6,000. We're going to put that onto the line of credit. Boom, back to full. Now we're going to go to the next step. The income, our remainder income of that $6,000 will be $4,800. We're putting that all towards the expenses. It's going to leave us with $600 left of expenses. We're going to use our line of credit, since it's paid in full, to pay those expenses off. We're going to be left with $2,400 in our line of credit. We see our debt chart over here. We started at $3,000. We're down to 0. So again, all we're pretty much doing is our patented income pays credit, credit pays expenses. This is pretty much the equation that you're seeing and how we're able to get this paid off. All right, we're at the last month. We hung in there. So let's get this knocked out here. So we are avoiding step one because we have all our credit cards paid off, maximize the cash flow using our velocity banking strategy. We're going straight to step two. What we're pretty much going to have to do is look at the line of credit at the end of August, starting September, was $2,400. So we're going to pay that off. We're going to use $600 out of Mr. and Mrs. Bounce Back's income of $6,000, and we're going to pay that back to full. What we're going to do is go down to the next step. We're going to use the remainder of our income, which miraculously is $5,400, as much as the expenses. So we're going to use all our money to pay off our expenses, and it's going to equal zero. So this last step, our line of credit's paid in full. We have no expenses, and our line of credit, $3,000. So if we're looking at this here, we had, let's see, $5,000 of debt, and we started with a cash flow of $300. So if we were just paying the $300 on to the credit cards, we would have not got that paid off in 9 months. It would have took longer than 9 months to pay that off. And this is assuming we can see that there's no interest that I put on here. So this is just kind of the basic equation. If we added interest and you were just doing 300, 300, 300, that's not all going towards the principal of the credit card because they're adding interest on that. So just note that as well too. So it would take a lot longer time to pay that off. Now the other thing that we do have to note is when you take money out of your line of credit, the $3,000, it does accrue the simple interest. So if you have not watched my videos on how to calculate simple interest, definitely take a look at that so you know that the line of credit, it is going to charge you a little interest, but what we're pretty much doing here is we're freeing up cash flow. This is why we use the line of credit, because the credit card does pay in simple interest as well. But if we're able to pretty much use the line of credit to pay one or multiple cards off and then pay that line of credit off, we're reducing our interest a lot. So it's pretty much like consolidating basically. So again, we are using the simple method of income pays credit, credit pays expenses. If this video was helpful, definitely leave a thumbs up, press that like button. I know this could be a lot of information to take in. If there is something that is confusing you or if this wasn't a good explanation, definitely leave a comment. If it was a good explanation, leave a comment as well. This helps me get feedback. This feedback helps me become better at explaining this to you guys here. So it is greatly appreciated. If you haven't done so yet, definitely hit that subscribe button. Share this video with others. We are trying to get a higher audience base and I appreciate it. So like always, you guys peace out. Have a good weekend.